Yeah, look, in many ways, it was a sort of tale of two halves when you look at the financial year just ended for precious metals. So obviously, an extremely strong run from July through to January, and then the last 5 months of the year, a quite significant pullback, which culminated in gold in particular falling by around 15% in the final quarter of the financial year, which was its worst quarterly performance in over a decade. So, it's important though that you do go back to that first period, and indeed, really the couple of years prior. So gold had gone up for, the better part of 10 quarters in a row. And even after this pullback, if you look at the sort of 3-year return, you're talking about 30% annualized and silver outperforming. So it has been an unbelievably profitable period for precious metal bulls. And so the pullback that we've seen in the last few months, it really, in many ways, it was not unexpected, quite healthy, just to sort of clear out all of the sort of froth and excess speculation that we were starting to see in the market, particularly by the end of January this year. And I think perhaps more importantly for people watching this video and looking at investing, something that we'd seen many times before in this sort of 25-year bull market for precious metals. It is not uncommon for gold and silver to have these pullbacks where they give up, let's call it 20% of their price gains. For gold in particular, that helps reset the market, and then typically we move on to bull market resuming. In terms of what drove the market, if you look at the period where it was rising, incredibly strong central bank demand, ETF flows were very positive, strong bar and coin demand as well, and a little bit of FOMO and greed coming in towards the end there. The pullback, several factors: rising US dollar, rising bond yields, complete repricing by the market around interest rate expectations. So, all of those things have been driving gold and silver over the last year, and that's why we are, where we are today. Look, I'd have to say, in a nutshell, out of the ordinary. So if you take the, let's call it 25-year bull market in precious metals as a whole, there have kind of been 4 seismic events, each of which helped push the profile of gold and demand for gold to a new level. And those are, the September 11 attacks and the original war in Afghanistan, all the way back in 2001. There was then obviously the global financial crisis, which was sort of late 2007 to early 2009. That's when it was at its, at its most elevated. Then Brexit in 2016 and COVID in 2020. What we saw in the last 12 months, I would say, dwarfed all of those elements combined. So those were periods where gold demand and gold prices tended to do very well. Gold demand was very strong. But what we saw in the last 12 months in terms of not just buying, but the interest in gold, the media attention, you name it, was larger than all of those by a significant magnitude. So I wouldn't say gold has gone completely mainstream now in that everybody's doing it, but it's something that is top of mind for investors now, and it is certainly completely different to what we saw. Even if I think back to the global financial crisis, if you said you were a gold buyer, around then, people were extremely surprised. It just wasn't something that many people did at all. The profile of gold and the interest in gold is on a totally different level now, and I think that bodes very well for the future. I think the key takeaway is to stay in it for the long term if you're going to be an investor in precious metals. The price performance from any given day or week or month or even quarter, can be misleading, or you can get super optimistic or super pessimistic if you look at gold and silver, and indeed any other asset class, with those really short-term timeframes. But gold in particular, its unique role that it can play protecting wealth, its market size, its liquidity, its complete absence of credit risk, none of those characteristics that make gold special have gone away. And the importance of owning an asset in your portfolio that has those characteristics is as strong today as it ever was. So I think the key thing for investors to take away is to look at the long-term returns. Despite the recent pullback, they are incredibly healthy. Look at the overall market environment, the continued threats from inflation, overvaluation in risk assets, you name it. The requirement or the sense of owning a wealth protecting asset like gold and silver, as I say, is as strong today as it ever was. And that's the key thing I think people should be keeping in mind when they look at their portfolio today and the potential role that precious metals can play. Yeah, look, it's obviously the question that's top of mind for all precious metal investors and market commentators. Starting with the first part, what drove the pullback, there were really six or seven things. The first one was that gold and silver were just incredibly stretched by the end of January. It's obviously something we'd been talking about and commenting on in our market updates and monthly market reports, that they were looking quite overbought. We were often looking at gold versus its 200-day moving average. And so there is no doubt that there was a lot of froth that had built up into the market by end January. So part of that just had to come out. And then if you look at the sort of market forces that have played out over the last 5 months, you've had an exceptionally strong US dollar, broke out to a 1-year high if you look at the dollar index, and it's at a multi-decade high versus the Japanese yen, which is a major cross that market participants look at. We saw an increase in longer-term bond yields. We saw a market repricing around what people think the Fed or the market thinks the Fed will do. Start of the year, people were thinking rate cuts. Now there's 2 and a bit rate hikes that are priced in. So all of those factors have been headwinds for gold. You also had, and it's really quite incredible in some ways, given it was occurring against the backdrop of the war with Iran, but you had a huge surge on Wall Street as well. From kind of late March through to early May-ish, there was a circa 20% rally in the S&P 500. Tech stocks did even better because it was tech that was sort of leading the charge. So all of those factors created headwinds for precious metals demand and precious metal prices. And if you add those market factors to the overbought status that gold and silver were sort of sitting at by end January, the pullback that we've seen is not unexpected, even if it's been a little bit painful for precious metal investors, especially those that may have only allocated or upped their allocations in late 2025, early 2026. I think the important thing to keep in mind, though, is if you look at many sort of historical observations over the last 25 years, the pullback that we've seen in gold in percentage terms is entirely in line with historical observation. And a price point around $4,000 US, which is where we sort of ended the financial year, was sort of smack bang with where we thought the market might pull back to when this corrective period played out. So I'm incredibly optimistic from here. I don't think we're going to surge back to all-time highs straight away, but I think the worst of the pullback for certain is behind us, and the long-term bull market for precious metals is completely unimpacted or unaffected by what we've seen in the last 5 months. Look, I think it's the same key macro factors that are always part of the gold discussion. Does the US dollar continue to rally? If it does, that might be a bit of a headwind in the short term. Do bond yields continue to rise? Does the Fed actually follow through with a couple of rate hikes like the market is now expecting? I think if you look at the recent comments coming out of the Fed, I don't think they're going to, or they might try and squeeze one rate hike in, or they may not. Employment figures that came out overnight were very soft, and that was part of the reason gold had a little spike back above 4,100, literally as we're talking right now. I think there's a big question mark around what happens with Wall Street as well, and the S&P and the Nasdaq. There's obviously been so much hype building in around the AI trade. It's sort of eerily reminiscent of what we saw 25 years ago when the Nasdaq originally soared and then crashed, and ironically that coincided with the very beginning of the secular bull market in gold. So I think all of those factors will be relevant. What happens with central bank flows will also be important. There's a lot of people now that are sort of questioning the central bank gold buying sort of narrative, but all of the data and all of the surveys from central banks suggest we're going to continue to see pretty strong buying from there. Retail demand is still healthy, although it's pulled back a little bit from, or pulled back from what we saw at the back end of last year and the start of this year. So there are a lot of factors to keep in mind. I think, overall, as I stated before, the market is a much healthier position now, and the case for gold sort of remains as strong as it has. I'm quite optimistic in terms of the outlook for gold right now. Perhaps not as bullish as some of the other strategists that are out there that are talking, kind of like an imminent return to 5,000 or 5,500 new all-time highs for gold. I think that will take some time. We've obviously done some analysis that suggests, when gold has these pullbacks, it can often take a couple of years before it gets back to that prior all-time high. So if we think, the high was January 2026, then you may be talking January 2028 before you get back to $5,500. But it's worth pointing out, if you buy gold at around 4,100 today, you're going to have generated an incredibly strong return even at the point it gets back to the prior high, let alone moving on to new highs. So I think, those are all things that I'd be keeping in mind as an investor. I have been adding more to my own portfolio, in this correction, and very comfortable with that decision so far. That would be an astronomical return and about face for the market, given there's only 6 months left in the year now. For gold to get the sort of intraday high was close to USD $5,600. So for it to climb from, let's call it 4,100 right now to 5,600 in the space of 6 months, that's an astronomical price gain in percentage terms. And given we're still in this sort of corrective period, even though I think bulk of the corrective period is behind us now, I'd be a little surprised if it got back there that fast. And again, I'm sort of trying to use history as a guide here. In all of the pullbacks we've seen for gold in this 25-year secular bull market, it was generally a couple of years for gold to get back to its all-time highs. So I'm optimistic that prices are going up and going up meaningfully from here. I don't know if it'll be that fast, but I also think that's not really the key question investors should be asking themselves. Everybody obviously gets excited by the idea of an all-time high, and obviously everybody wants the performance to reclaim what feels like lost ground now. But I would turn the question around a little bit and say, well, if gold ended the year at $4,500 US, that's a 10% return from here. That's in line with gold's long run returns. That's a fantastic return for an exceptionally liquid, zero credit risk, asset, which is the reason you hold gold in your portfolio. So I am extremely confident we will get back to all-time highs and go many thousands of dollars higher over the long term. Not sure we'll hit that number in the next 6 months.